Hello and welcome to this video. In this video, we are going to do a A-level accounting question from paper 3, Feb-March 2023, question 3. The question states that the draft statement of financial position of T Limited at 31st December 2022 is as follows. Non-current assets in which we have property, plant and equipment is $425,000. Current assets in which we have inventories are $42,000. Trade receivables are $225,000. Other receivables are $6,000. Cash and cash equivalents are $74,000. The total of current assets are $347,000 and the total of assets, that is current assets as well as non-current assets together, are $772,000. Equity, in this we have ordinary share capital and the face value of each share is $1 each and the total ordinary share capital is $400,000. Share premium is $35,000. Revaluation reserve is $60,000. Retained earnings are $86,000 and the total of equity is $581,000. Current liabilities, in which we have trade payables, which is $152,000. Other payables are $39,000. The total equities are $191,000. The total equity and the liabilities together are $772,000. The following information is also available. A proposed dividend of 5 cents per share has been accounted for and set against the retained earnings accordingly. A machine cost of $42,000 was purchased on 1st July 2022. On the same date, T Limited also paid $8,000 for a 4-year repairing contract starting on that date. The total amount of $50,000 has been included in the machinery account. Depreciation on machinery is provided at 20% per annum using the reducing balance method with a full year's depreciation in the year of purchase. The only property of T Limited was revalued upward by $60,000 2 years ago. This property was revalued again on 31st December 2022. The decrease in the value of $35,000 had been set against the retained earnings. The carrying value of motor van, $27,000, was included in the value of non-current assets on 31st December 2022. The value of motor vans was reviewed on that date. It had a value in use of $23,200. If it was sold, it could be sold for $24,500, but a selling cost of $1,800 would be incurred. In December 2022, an employee was injured on the office premises. The legal proceedings have started. The company's lawyer has advised that T Limited will probably be found liable and the compensation would be $9,000. As the case will be heard in the court in April 2023, the directors had not accounted for the compensation in the drafted financial statement. In the EBIT, we are asked to explain with reference to relevant international accounting standards the appropriate accounting treatment for the item in the first, which we have is information 4, and we have to support our answer with calculations. And the information which was given was the carrying value of the motor van was $27,000, was included in the value of non-current assets on 31st December 2022. The value of motor van was reviewed on that date. It had a value in use of $23,200. If it was sold, it could be sold for $24,500, but a selling cost of $1,800 would be incurred. This comes under IAS 36, which is impairment of assets. Impairment occurs when the carrying value, here the carrying value which is given is $27,000, and when this is permanently reduced because of any reason, because of wear and tear, because of market fluctuation. If this is permanently reduced and we have a recoverable amount which is lesser than this carrying value, then impairment occurs, and this is stated in IAS 36, which is about the impairment of assets. Now, what is this carrying value means? Carrying value is the net book value. And what is net book value? We take the cost of assets, from there we subtract the accumulated depreciation, and then we get this value which is called as the carrying value. And what is the recovery value or recovery amount. Here it is higher out of these two things, that is the fair value of the asset or the value in use of the asset. Here if you see the motor van, it was mentioned that this can be sold for $24,500 and it has a selling cost of $1,800. So for fair value, we'll take this selling price, which is $24,500, and we subtract the selling cost of $1,800, and we will get the fair value as $22,700. And the value in use which is given here is $23,200. So out of this, whichever is higher, that is value in use is higher, we will take this as our recoverable value. And you see, we get a impairment loss whenever there is an impairment of asset, that is the carrying value have been reduced permanently, and this occurs when the carrying value is higher than the recoverable amount. Here the carrying value is $27,000 and the recoverable amount or value which we have taken is the value in use, which is $23,200, and when we take the difference we get a loss of $3,800. And because of the impairment of asset, the motor van will be permanently reduced by this value. So this is because the depreciation was understated, and hence now the value of motor van should be reduced by this $3,800. So how do we recognize this? We take it as an expense in profit and loss statement, and apart from that we will reduce the motor van by this amount in our statement of financial position. Now, as I have explained you about the IAS 36, now we will proceed further and write the answer for this question. In this, we will first state that it is from IAS 36, impairment of assets. Then we will mention that the recoverable amount is higher of fair value, which is less cost to sales, that is 24,500 minus 1,800, which is $22,700, and the value in use is $23,200. The impairment loss is $3,800, which is the amount of carrying value, which was $27,000, and this exceeds the recoverable value, which is $23,200, and should be recognized in the statement of profit and loss, and the carrying value is reduced accordingly. Next, we have to explain information 5 with relevant international accounting standard, and the information given is: in December 2022, an employee was injured on the office premises. The legal proceedings have started. The company's lawyer has advised that T Limited will probably found liable and the compensation would be $9,000 as the case will be heard in court in April 2023. The directors had not accounted for the compensation in the drafted financial statement. Here the information stated is about the legal proceedings. This is the legal lawsuit, and still there is the pending outcome of this lawsuit, and based on this they may be liable to pay the amount to the employee, and this comes under contingent liability, and contingent liabilities comes under IAS 37, where we make the provision for contingent liabilities and contingent assets. So how do we recognize the provision for this contingent liability? It is done based on these 3 pointers, that is, a present obligation exists as a result of past event, and here this is on the basis of a past event, that is, the employee was injured in December 2022 and the payment is probable, and here it is mentioned that the lawyer of the company have said it will be probable that they have to pay the compensation, and hence it is considered that it has more than 50% chance because the court case have already been started, and even the lawyer has advised that they have to pay because they may lose the case, and then the amount should be estimated reliably. Here we have a reliable estimation of amount of $9,000. So based on this we will make a provision for the lawsuit which is pending, that is a provision of $9,000. And how do we recognize this? This will be recognized as an expense in the profit and loss statement, and it is also recognized as current liability as it has to be paid within a year period of time in our statement of financial position. Now, as we have already understood what is IAS 37, let's proceed and answer this question. will state that this comes under the claim of IS 37, which states about the provision, contingent liabilities and contingent assets. The incident occurred in December 2022, is a past event. On the basis of the legal advice that T Limited is probably liable for the compensation, it is a liability, and a provision for 9,000 should be made for the year ended 31st December 2022. In the B bit of the question, we are asked to prepare a statement showing the adjusted retained earning at 31st December 2022. So we'll start with the working notes and then we will make the statement. The first additional information which was given was a proposed dividend of 5 cents per share had been accounted for and set against the retained earnings accordingly. You see, proposed dividend, this will be proposed in the AGM, that is annual general meeting, which occurs after the closure of financial year. This will be taken into consideration when there is an AGM. The shareholders will vote for this dividend, and if they agree, then only this dividend will be paid. Hence, what we do with the proposed dividend is that we will just add it as a note to the final accounts, as it is not paid or not finalized till the shareholders vote for it. So what we do is we just write it as a note to the final accounts. However, here what we have done is we have set it against retained earning. That means it has been subtracted from the retained earning, as well as it was considered as a current liability because we have to pay this to the shareholders. So this will be how we will set it against the retained earning, that is we subtracted from the retained earning and we add to the other payables. So this have to be rectified. For this, first what we will do is first we will find what will be the amount of proposed dividend. For this, first we have to find the number of shares because this is the dividend paid per share, that is 5 cents is per share. So first we have to find the number of shares. For this, what we will do is we will take the ordinary share capital, which is given as $400,000, and each share has a share value as $1 will be the face value of this share. So the number of ordinary shares will be 400,000 divided by $1, which will be 400,000 will be the number of ordinary shares which have been issued. And with what we will do with this is we will take this and multiply it with the dividend per share, that is 400,000 times 5 cents. We get the proposed dividend as $20,000. So now this have to be added back to the retained earning, as this is proposed dividend and this is not the dividend paid, that is interim dividend. Only interim dividend will be considered. This is proposed dividend, so we are not going to take it out from the retained earning, hence we have to add this back. Apart from that, this will be also mentioned in the other payables as current liability, and hence we have to subtract this amount from the other payables as well, that is other payables were given as $39,000. From there we subtract this $20,000. Apart from that, one more thing which have to be added in the other payables was what we have done in the A bit 2, that is this, that is the provision which is to be paid for this contingent liability. So this also have to be added to complete the other payables. So what we'll do is we'll take $39,000 minus $20,000 plus $9,000, and $28,000 will be our other payables. The second additional information is a machine cost of $42,000 was purchased on 1st July 2022. On the same date, T Limited had paid $8,000 for a 4 years repairing contract starting on that date. The total amount of $50,000 have been included in the machinery account. The depreciation on machinery is provided at 20% per annum using the reducing balance method with the full year's depreciation in the year of purchase. You see, this is the error of principle where revenue expenses, because repairs are revenue expenses, is treated as capital expenditure. This 8,000 should not be a part of the cost of machinery. However, they have taken 50,000 as cost of machinery instead of $42,000. So here what we have done is we have taken the revenue expenses and added to the cost of machinery, which is not fair. So we have to do the adjustment for this. So what we have to do is this 8,000 is fictitious asset. That is, this is for 4 years period we have prepaid our expenses. And when we have prepaid expenses like advertisement expenses, preliminary expenses, which are prepared for a period of time, these are fictitious assets and these have to be included in other receivable. However, the revenue expense of this year, that is, they have purchased the machinery at 1st of July. So whatever repair expenses which occur from 1st of July till 31st of December, that is 6 months, will be charged against the retained earnings, because this is an expense. So what we will do is, first we'll take 8,000. This is for 48 months, that is 4 years will be 48 months, and for 6 months how much? So when we cross multiply it, we get 8,000 times 6 divided by 48, which will be $1,000. So this will be charged against the retained earning, and the leftover, that is from 8,000, when we subtract 1,000, we get 7,000. This will be other receivable, because this will be a part of our current assets and these are fictitious assets. So other receivable was given as $8,000. To this we will add this $7,000. We will get $13,000 as other receivable. And what else we have done? We have considered this as the cost of machinery, that is, this 8,000 was also considered as the cost of machinery, and hence we have depreciated this amount as well, whereas this is our fictitious asset, hence they should not be depreciated. So what we are going to do is, we are going to find the 20% per annum, and as this is the first year, so using reducing balance also, we will just multiply it with 20%. So 8,000 times 20% will be 1,600. This is the overcharged depreciation, and this should be added back to the retained. And one more thing which you have to remember is, we have taken a whole year's depreciation, that is a full year's depreciation have to be charged in the year of purchase. So this depreciation for a whole year, not for 6 months. Okay. And then what else we have to do is, we have to take the property, plant and equipment and do the adjustments. Here it was mentioned that the value for this was $425,000, and from there we have to subtract this 8,000, because this is 8,000 is for repairs contracts and this will be a part of other receivables. So we have to subtract this, and then we have overcharged this depreciation. So we are going to add this back, because we have charged this depreciation for this 8,000, which should not be charged, so we are adding this back. Apart from that, there was an impairment loss which we have considered in EBIT 1, where we have an impairment loss for motor vehicle, and that have to be subtracted. So after subtracting and adding, we get the value for property, plant and equipment as $414,800. Now we have a third bit of information which states that the only property of T Limited was revalued upward by 60,000 2 years ago. That is, only property was revalued, plant and equipment was not revalued upward. So this revaluation reserve is only for property. This 60,000 was only for property. This property was revalued again on 31st December 2022. The decrease in revaluation of 35,000 has been set against retained earning. You see, whenever we have revaluation reserve, if the value of the same asset which we have revalued upward is decreased, we will subtract it from the revaluation reserve, not the retained earnings. So for this, what we are going to do is, we are going to add back this 35,000 to retained earning, and we will subtract this 35,000 from the revaluation reserve which was given as $60,000, and from there we will subtract this $35,000. So we will be left with the revaluation reserve as $25,000. And we have already done the required calculations for fourth and fifth information which we did in the A bit of the question. So now we are done with all the working notes. Now as we are done with all the calculation, in the B bit of the question we were asked to prepare the statement showing the adjusted retained earning at 31st December 2022. Now we are going to make that statement. We will start with the drafted retained earning. This was the retained earning which was given as $86,000. Then the proposed dividend which we have calculated in the first working notes, and proposed dividend is just added as a note to final accounts. This should not be set against the retained earning, hence we are going to add that back $20,000 which we have calculated in the first working notes, and then the rebates which we have calculated in the second working notes. This is an expense, and expense need to be subtracted, so we are going to subtract this $1,000. And then depreciation overcharged, we have overcharged this because we have taken the repairs contract as well as the cost of machinery. So we have overcharged that. As we have overcharged that, we are going to add this back as $1,600 which we did in the calculations was done in the second working notes. And then the revaluation loss for property, this should be set against the revaluation reserve, not the retained earnings, and by mistake it was set against the retained earnings, hence it is added back as $35,000. Then the impairment loss, which we have calculated in the first A bit of this answer, and this was $3,800 for motor van, and as this is a loss it have to be subtracted, and hence we have subtracted 3,800 from the retained earnings. Then the provision for compensation, which was done in the second of A bit, and this was for the payment of the lawsuit, and as this is considered as a expense, hence it should be subtracted, and hence we have subtracted this provision for contingent liability from the retained earnings. So after adding and subtracting, we get the adjusted retained earning as $128,800. In this bit of the question, we are asked to prepare an adjusted statement of financial position at 31st December 2022. So we will make the statement of financial position at 31st December 2022 starting with non-current assets, and we have property, plant and equipments. For this we have done the calculation in the second working notes, and we got the value as $414,800. Then we have current assets, in which we have inventories, and inventories does not have any adjustment, so we'll take the value as it is, that is $42,000. Trade receivables, again there was no adjustment, so we'll take the value as it is as $225,000. Other receivable, there was an adjustment, and we did the calculation in the second working notes, and now we are going to take that value as $13,000. Then we have cash and cash equivalent, again there was no adjustment, so we'll take the value as $74,000. We will add the current assets, that is 42,000 plus 225,000 plus 13,000 plus 74,000. We will get the value as $354,000. Then the total assets, which is the total of our non-current assets and the total current assets, we get the total assets as $768,800. Now we have equity. In equity we have ordinary share capital of share which has a face value of $1 each, and the value was $400,000. Share premium, which is $35,000. Revaluation reserve, for which we did the calculation in the third working notes, which we got as $25,000. Retained earning, which we got in the bit B of the question as $128,800, and when we total this up, we get the total as $588,800. Then we have current liabilities, in which we have trade payables, we have $152,000. Other payables, for which we did the workings in the first working notes, and we got it as $28,000. So when you add this, it is $180,000. And now we'll take the total of equity and liability, that is $588,800 plus $180,000. We get the total as $768,800. And our statement of financial position is balanced, that is total assets is equals to total equity and liability. So we are done with the statement of financial position. Lastly, we have bit D of the question, which asks us to state three responsibilities of an external auditor. The three responsibilities of an external auditor are: first, they have to examine the books, that is the journals, ledgers and the final accounts of the business. They have to ensure that the financial statement complies with both IAS and FRS standards of the accounting, and then they have to verify that the existing assets and liabilities are accurately stated, neither they are understated or overstated. They have to test all these things and carry a audit test, and then they have to prepare the audit report and state whether the books as well as the accounts shows the true and fair picture of the business or not. And with this, we have completed this question.
Thanks for watching my videos. Have a peaceful and blessed life.